Welcome to Cost Saver Conversations. I'm Angela, and I ask the practical questions so you can quickly understand what matters. Today, I'm joined by Assad.
Hi, Angela. We are unpacking Scotland versus rUK income tax 2025-26, what the six-band system means for your take-home pay today, and tying it back to the wider cost-saver ecosystem, including tools like Scotland versus rUK income tax engine 25-26, six-band, so you can turn insights into action quickly.
Just a heads up before we dive in, we are your synthetic hosts. We are great with numbers, but as AI, we can sometimes be confidently wrong. Think of us as the digital versions of your most knowledgeable, slightly caffeinated friends.
Exactly. Treat this chat as a smart estimate only, not as professional financial guidance. Always check important details with official sources or a qualified expert before making any big decisions.
Welcome back to the Cost Saver podcast. Today, we're getting into something that I think is increasingly relevant for a lot of people, Scottish income tax and how it compares to the rest of the UK for 2025-26. Assad, I feel like every year we talk about this, the gap just gets wider.
It really does. And honestly, it's not subtle anymore. Like, if you'd moved from Manchester to Edinburgh 10 years ago, your payslip would have looked basically the same. Move today? Genuinely different picture.
Genuinely different how? Like, are we talking noticeable on your monthly payslip different?
Yeah, absolutely. Someone earning £50,000 in Scotland is handing over roughly $1,542 more per year than their equivalent in, say, England. And above $75,000, it widens into thousands. So yeah, you'd notice it.
Okay, wow. So what's actually driving that? Is it just higher rates, or is there something structural going on?
It's structural. The thing is, the rest of the UK still runs a fairly simple three-band system: basic, higher, additional. Scotland now has six bands.
Six?
Six, including a starter rate, an intermediate rate, and this relatively new one called the advanced rate. So it's a completely different architecture at this point.
And that's not just like bureaucratic complexity for the sake of it?
No, it's deliberate. The Scottish government's logic is raise more from higher earners, give a small break to people on lower incomes. Whether you think that's fair or frustrating kind of depends on where you sit on the pay ladder, you know?
I hadn't thought about it like that. Okay, so walk me through the actual numbers. Let's start with what people in the rest of the UK are used to.
Sure. So both systems share the same personal allowance, $12,570 tax-free. That's set by Westminster, not Holyrood. Then for rUK, it's 20% basic rate up to $50,2070, 40% higher rate up to $125,140, and 45% additional rate above that. Pretty clean.
Right, that's the one most people are familiar with.
Exactly. Now Scotland, okay, deep breath. After that same $12,570 personal allowance, you've got a 19% starter rate up to $15,397, then 20% basic rate up to $27,491, then 21% intermediate up to $43,662, then 42% higher rate up to $70,000, then 45% advanced rate up to $125,140, and then a top rate of 48% on anything above $125,140.
Wait, so the higher rate in Scotland kicks in at 43,663? That's what, nearly £7,000 earlier than in the rest of the UK?
Nearly 7,000, yeah. And the top rate is 48% instead of 45%. Those are the two things that really jump out. The advanced rate, that was introduced for 2024-25, and it's continued. That was the biggest structural change in years. Does that make sense so far?
It does, yeah. So is there a specific income level where Scottish taxpayers start paying more, like a crossover point?
There is, and it's the number worth remembering, roughly $28,867. Below that, Scottish taxpayers actually pay slightly less because of that 19% starter rate.
Oh, that's kind of reassuring for lower earners, I suppose.
It is, but, and I don't want to oversell it, someone on $20,000 saves about $22 a year compared to rUK. So it's, it's real, but it's not exactly transformative.
22 quid, a nice dinner out maybe.
If you're careful about where you eat, yeah. But above that crossover point, it moves fast. At 35,000 pounds, a Scot pays about 54 more. At 50,000, it's about 1,542 more. 75,000, about 2,043 more. And at 150,000, you're looking at roughly 4,543 more per year.
At the higher end, that's significant money. Over 4,500 pounds.
It is, and the steepest jump is around that 43,663 mark, because that's where Scotland's higher rate of 42% kicks in. But in the rest of the UK, you'd still be on 20%. So there's this awkward zone between about 43,663 and 50,270, where the marginal rate gap is 22 percentage points. Every extra pound you earn, you're keeping dramatically less of it compared to someone doing the same job in Newcastle.
22 percentage points. That's wild. So a bonus or overtime in that range just...
Feels considerably less rewarding, yeah. And it gets worse when you layer on national insurance, which, and this is the bit people miss, is not devolved. NI is set by Westminster, identical across the whole UK.
Right, so NI is the same everywhere. But that creates a weird interaction with the Scottish bands?
A massive quirk, because NI stays at 8% until $50,270. So a Scottish taxpayer in that awkward zone is paying 42% income tax plus 8% NI. That's a combined marginal rate of 50%. Meanwhile, their rUK equivalent on the same income is paying 20% plus 8%, so 28%. Same slice of income, 50% versus 28%.
50% marginal rate. That's a lot.
It's a lot, and most people don't fully register it until they see their bonus pay slip and go, wait, where did half of that go?
So let me ask you about a real-world scenario. You mentioned someone earlier, Sarah?
Yeah, Sarah, project manager, relocated from Leeds to Edinburgh in April 2025 on $58,000. Under rUK rates, her annual income tax bill would have been roughly $11,432. As a Scottish taxpayer, with that S prefix on her tax code, it climbed to about $13,120, so an extra $1,688 a year, or about $141 a month.
Ouch. But she planned for it?
She did, which is the whole point. She checked the numbers before signing her offer letter, and then she bumped her workplace pension contribution by 3%. At a 42% marginal rate, the relief on that is substantial. So the actual net hit to her monthly take-home ended up closer to 60 pounds.
Oh, that's actually okay. So that's a smart move. Which brings us to pensions, because I imagine they become even more valuable for Scottish taxpayers?
Disproportionately valuable, because relief is at your marginal rate. A Scot in the higher band gets 42% relief versus 40% in rUK. In the advanced band, it's 45%. And if you can do salary sacrifice, which is where your employer reduces your gross salary and pays the equivalent straight into your pension, you avoid both income tax and NI on that slice. So every $100 sacrificed can effectively cost only $48 in take-home pay, but $100 goes into your pot.
I was gonna say, actually, hold on. Is there a catch? Like, do you have to do anything special to claim the higher relief?
Good question. It depends on your pension type. With salary sacrifice or a net pay arrangement, which is what a lot of workplace schemes use, relief happens automatically at your full marginal rate. But if you're using a relief at source pension, like a personal pension or a SIP, your provider only claims 20% automatically. You have to claim the extra 22% or 25% yourself through self-assessment.
And people forget to do that?
All the time.
It's one of the most common tax reliefs left unclaimed by Scottish taxpayers. And, this is important, the deadline to claim for the 2021-22 tax year expires on 5 April 2026. So if anyone's been missing that for a few years, now's the time to sort it.
Good shout. Okay, so let's go back to something. Who actually counts as a Scottish taxpayer? Because I think this trips people up.
It does. It trips people up more than it should, honestly. It's based on your main place of residence during the tax year, not where you work, not where your employer is based, not where you were born. HMRC applies a pretty common sense test. If your only or main home is in Scotland, you're a Scottish taxpayer.
So, a commuter living in, say, Berwick-upon-Tweed but working in Edinburgh.
Remains an English taxpayer. Home is in England. That's what counts. And the reverse is true too.
What about students, like someone from Yorkshire studying in Glasgow?
Undergrads in halls with a family home in Yorkshire generally stay rUK taxpayers, but full-time postgrads who've genuinely relocated, they often do become Scottish taxpayers. And if you move mid-year, you count as a Scottish taxpayer for the whole tax year if Scotland was your main residence for more of it than anywhere else.
And you said there's an S prefix on the tax code?
Yeah, check your PAE tax code. If HMRC thinks you're a Scottish taxpayer, it'll have an S at the start. If you've moved recently, definitely check that, because getting it wrong for months can create a nasty reconciliation bill. And updating your address through your personal tax account at gov.uk takes about 10 minutes. Just do it.
Just do it. Fair enough. Now, what about people who are self-employed in Scotland?
Same squeeze. Scottish rates apply to trading profits, so self-employed workers feel it just like employees. And I should mention this, there's a trap people fall into thinking, oh, I'll set up a limited company and avoid Scottish rates. Corporation tax is UK-wide, sure, but the moment you draw a salary from that company, Scottish rates apply to it. Dividends stay on UK-wide rates, which is one reason some higher-earning Scots lean more heavily on the dividend route, but incorporation has its own trade-offs.
That's good to flag. So it's not a simple workaround.
No, it's really not. And look, the divergence also changes the maths on other everyday stuff. Like a £1,000 bonus for a Scottish higher rate taxpayer nets around $500 after income tax and NI. For an rUK basic rate taxpayer on a similar-ish salary but just below the rUK higher threshold, that same bonus nets about $720.
That's over 200 quid difference on the same bonus.
Right. Or company cars. Benefits in kind are taxed at your marginal rate, so Scots pay more tax on the same company car than an rUK colleague with the same salary. That can shift whether you're better off taking a cash allowance instead.
So if you're considering a job offer that involves moving across the border, you really can't just compare headline salaries.
You really can't. A $55,000 offer in Newcastle is not the same as $55,000 in Edinburgh. The difference matters for your rent, your mortgage, all of it. You need to run it through a proper take-home calculator that accounts for residency.
And where's all this heading, do you think? Is the gap likely to keep growing?
I mean, nobody has a crystal ball, but the direction of travel has been pretty consistent for several years now. More bans, higher rates at the top, modest protection for lower earners. The advanced rate was only introduced in 2024-25. I'll be surprised if that's the last structural change. Next Scottish budget is due in December, and any adjustments would apply from 6 April 2026.
Which is sort of not a lot of lead time.
No, and then there's fiscal drag happening in the background. The personal allowance and the rUK higher rate thresholds have been frozen since 2021-22, and they're staying frozen for several more years. So wage inflation is quietly pulling more people into higher bands, even without any rate changes. Scotland's thresholds have moved slightly year on year, but still lag behind wage growth for higher earners. It's one of those things, you know?
It does feel like one of those things where if you're not paying attention, it sort of creeps up on you.
That's exactly it. And that's why I'd say, for anyone earning above about £45,000 in Scotland, building tax planning into your regular financial routine isn't optional anymore. It's not a one-off exercise. Review your pension contributions, understand your marginal rate,
time bonuses where you can.
Okay, so let's wrap this up with the practical takeaways. If you're listening to this and you're a Scottish taxpayer or thinking about becoming one, what should you actually do?
Right. So first, know where you sit. Below about 28,867 pounds, you're actually marginally better off in Scotland. Above that, and especially above 43,663, the gap grows significantly, and you need to be aware of it.
Go on.
Second, use pension contributions and salary sacrifice. They work harder for you in Scotland because of the higher marginal rates, 42% relief in the higher band, 45% in the advanced band. And if you're on a relief at source pension, claim that extra relief through self-assessment. Don't leave it on the table.
Right.
Third, check your tax code. Make sure it has the right prefix, S for Scotland. If you've moved recently, update your address with HMRC. It takes 10 minutes and saves you a potentially nasty surprise down the line. And fourth, honestly, just run your specific numbers. We've got the Scotland versus rUK income tax engine on the site. It takes about 2 minutes, gives you the difference in actual pounds and pence for your salary. Way more useful than relying on averages.
That's really solid, practical advice. Don't panic, don't plan a hasty move across the border. Just understand the numbers and plan around them.
Exactly. Tax policy is one of the clearest ways devolution touches everyday life now. Being informed about it it matters.
Aside, thank you. This has been genuinely useful. I feel like I've learned things I should have known already, which is sort of the best kind of episode.
My pleasure, Angela. Always happy to talk tax bans, which I realize says something about me, but there we go.
We'll take it. Thanks for listening, everyone. Links to the calculator and the full breakdown are in the show notes. See you next time. Quick side note, this guide connects with other cost-saver blogs, especially NI Gap State Pension Top-Up ROI and Pitfalls, Company Car vs. Cash Allowance UK Tax 4, and UK Salary Reality Checker ASH 2025 Guide.
Exactly, and reading those together helps you connect the dots across your household budget, not just this one topic in isolation.
And if you want to apply this immediately, jump into tools like Scotland vs. rUK Income Tax Engine 2526 6-band right after this episode.
Primary sources used here include Scottish Income Tax Rates and Bands 2025 to 2026 and Income Tax Rates and Personal Allowances, so you can verify the data yourself and stay evidence-led.
That wraps this cost-saver conversation with Angela and Assad. If this helped, share it with someone who could put these ideas to work this week.
Your next step is simple. Try Scotland vs. rUK Income Tax Engine 2526 6-band, then read NI Gap State Pension Top-Up ROI and Pitfalls, and use them together to take action today.